So hi guys, it's James here, and I've got online with me Tim Hart, and we're going to chat about Tim's latest investment up in Rockhampton in Queensland. And you guys might remember Tim. He's one of the original course members and has done very very well, and has actually set up a fund to buy commercial property. And this property here, it actually reminds me quite a bit of my property, although it's a lot bigger, that I had in Mackay, which was a very ornate and prominent building. Anyway, Tim, let's have a chat about this property and how you got it and how you arrived in Rockhampton and the amazing return that it's offering.
Sure. No, thanks, James. Thanks for having me on. So this deal in Rockhampton, I mean, just to back it up a little bit, we did a lot of research a couple of years ago, and we ranked every single town in Australia, mainly looking at regional towns, and we sort of ranked them from best to worst. And a lot of that is on the ground research that we did, as well as ABS statistics data, and really looking at towns that have got that strong population growth, got multiple industries, have got good population levels, good infrastructure spending, and we ranked them all, and basically got our top 30. And in that top 30 was Rockhampton, because it really ticks all those boxes. It's got a lot going for it.
Right.
And so that's what we quite like, that Rockhampton doesn't, it's got multiple employers there. It's got huge agriculture. It's the sort of that beef capital of Australia. It's got manufacturing. It's got tourism there. It's got the Shoalwater Bay training facility, which just got announced $1 billion upgrade, as well as it's got a little bit of mining exposure, with the Adani and that sort of thing.
Right.
The Adani mine just set up their head office, and a local Rockhampton company just got awarded the $100 million rail contract as well.
Wow.
That they think will bring about 750 jobs to Rockhampton. So we really like that there's lots of different employers and lots of different things that are feeding its economy. It's not a one-horse mining town.
I was going to say that's been a big issue, hasn't this sort of one-horse town, which actually sort of Mackay was maybe a half a horse town or something there, but it sort of ended up being a one-horse town just with the mining. And when the mining died there, boy oh boy, it went downhill. So that's so that's a pretty high level of research you've done, I guess, to filter down into this and then to be able to get this level of return. I mean, we're sort of quite often struggling to find returns, higher than 8, in even in some regional areas. So pretty amazing.
Yeah. No, indeed, I agree. Yeah, and this building came up. We've been negotiating on it. It's probably been a good 14 months now.
Wow.
A lot of these deals, and it was similar sort of story. I mean, if you remember Caboolture, it's just
Yes.
vendor wants too much money, and we just have to sort of wait until they're sort of ready to sell and ready to sort of meet the market. So what we did with this one is a little bit different. They sort of wanted in that $4 to $4.5 million for it. We thought it wasn't quite worth that. We ended up basically agreeing and said, look, we'll get a valuation done from a local valuer, like a bank panel valuer, and we'll agree that whatever they come up with, then we'll use that as the price. So the owner eventually agreed to that, and we got the valuation done, which came in at $3.8 million. And so that's based on a 9.25% yield.
Yep.
So, which for us, and what are really attracted to us is such a high yield, and the biggest thing with it is that it's fully let, so there's no sort of that vacancy risk, and it's got some phenomenal tenants in there. So the fact that we could buy it at such a high yield enables us to get the, like you'll see in the slide there, 11.2%
Yes.
return to our investors. So that's net after all fees, costs, charges,
Okay.
100% passive. You just sit back and every quarter we pay out that income.
So Tim, with that, I mean, do you is it something you could explain now to anyone listening how? So you bought the building, say 9 and a bit, and then if you did invest in this, you'd be getting 11.2. Is that something you'd rather chat about to people, privately, if they're interested in it?
In terms of how we get to that 11%, you mean? I mean, for us, obviously we're buying at the 9.25. Obviously, we are borrowing. We're getting some
Yep.
bank funding in there, which is quite, it's quite cheap funding. We're sort of talking sub 5 in terms of interest rate. So that really sort of gears that return up for
Right.
us
Okay.
to get us up to that 11. And as I said, that 11 includes management costs of managing the investment. So it really is a net return for the investors. So it is, but basically the way we're structuring these transactions is that we set up a brand new unit trust, and we're setting it up as a proper managed investment scheme. So we've got an independent trustee holding the asset for all the investors.
Right.
That it's got an information memorandum and a PDS. It's all registered with ASIC. There's a lot of work that goes in to make sure that it's all, it's a safe investment for people to be putting their money into, and that all the figures are being checked and verified and that sort of thing.
Right. Great.
So,
Well, I
so
think
basically we're just pooling investors,
yeah.
and someone can get into this thing for, we put the minimum investment's only 25 grand.
Yeah.
And you're
Okay.
getting 11% return. Whereas to normally buy this property, you'd literally need a couple of $1 million. So
Yes.
it's just making it super affordable and easier for people to get in that are looking for that, just that cash flow type of investment. So we've had a fair bit of interest from people with self-managed super funds and retirees and that sort of thing that like that high yield when the banks are paying 1% or whatever they are.
Yes. Yes. So. Oh no! Look, it's certainly could be part of anyone's strategy. I reckon to have. I guess this is like an indirect investment, and then you may have some direct investments as well, or wanting to park money, as you say. So I think we perhaps should chat about the tenants. So I'll move on to slide 2 because the all important tenants here, and you were mentioning that they're all pretty major groups by the look of it.
Yeah, so like you've taught us, it's really important to make sure you've got a quality tenant, and that's what attracted us to this one. Is that you see the first one we've got is Elders Insurance.
Yep.
I can't see an insurance company going out of business anytime soon. They're owned by QBE, ASX listed, $15.2 billion of market cap. Next one down there, we've got Artius, which is the disability employment and health services company. So they're actually partially government funded as well. So
Right.
we sort of see them a bit of as a government tenant, but really helping the local community there. The next one, Programmed.
Oh, yes.
So a lot of people around that they know them. You'll see they directly employ more than 20,000 people.
Wow.
And the company that owned them, actually, Purcell Group, sold the company last year for $780 million, I think it was, to a Singapore group that are listed overseas, and they've got a market cap of $8 billion. So it ticked a lot of boxes for us there. That's some great tenants. The next one we've got down is the Sunshine Coast Health Network. So this is more of a government tenant. So it's sponsored by the Australian government, their health department. And part of that funding, they've actually got 30 different offices all along the coast of Queensland. And they've actually got two tenancies in there that they're taking up. So the last one we've got there, actually, sorry, this is the one that's taken up 2 tenancies, the National Job Link.
Yeah.
So they're the ones that are taking up 2 shops, sort of 5 and 6. And they're non-for-profit. They've been around for a long time. They're originally out of Tasmania, but now they've really expanded up in there. And just really, it's all about helping people get employment in there. And with what we see going on, we think that should hopefully be quite an easy job with all the new jobs coming in.
Yeah.
So,
yeah.
Right. So they're the tenants. So that's what we were very happy with those. Good solid sort of spread, I guess, of 5 tenants, but some quality of tenants. So that's really what attracted us to this this building.
And obviously, if anyone chats to you about this later on, you can run through all the leases. We won't run through all those now, but you can. I know you've got an IM that you can send people out. I reckon let's have a look at the location. I must admit, I vaguely know Rockhampton. When I say vaguely, I've been there several times at the airport, but just driving through. So this obviously is a pretty prominent. It's over here in Bowles Over Street. Is that how you pronounce that? Bowles Over.
Yes. Bowles Over. Bowled over.
Bowled over, yeah. So bowled over with a good investment.
So it's really, it's in there, CBD if you want to call it that. There's just lots and lots of stuff going on around it. Just to the south of it, that little green area is where the council offices are.
Okay.
So it's a real main thoroughfare there, that William Street. So this sort of has those three street frontages.
Yeah.
So just to the south of it is, you can see, is the railway, the Rockhampton Railway, and then over to the left is obviously the airport, which you know well.
Yeah.
But it's all kind of there in that sort of zone. It is quite close to the river. However, it's not in a designated flood zone, which was quite important for us. And you mentioned before as well that the building isn't heritage listed, despite the fact that it was built in the 1930s.
Yeah.
So there's nothing there that is registered. So and it's also worth mentioning as well, the building about 8 years ago went under a major renovation work they did to it.
I'll just go back
I'll
just go back to the first slide so you see the picture. So they've done all new shop fronts and at that time, and perhaps painted it all up and all that. Imagine.
Yeah, that's right, and I think that's why. And this has lift, so it's got lift access, so it's all disability access, which is what's enabled us to get these government tenants, because that's what they have to have. That's what they really want. So this has been fully tenanted for quite a while, and it really demands those quality tenants because it's such a nice, impressive looking building.
Yeah.
So that's what we hope, that even if we did lose a tenant, then it's not going to be hard for us to find another quality tenant to take up the space.
Yeah, they sort of, a lot of these tenants too, they sort of feed off each other, don't they? They're all sort of, maybe not the elders insurance, but they've got the most prominent spot there. So we'll go to slide 4, and we're looking at, you've got a little bit of an initial upside here with some rental increases. Yeah,
so we always like to look at what, how can we add value to the building. This one, because it's fully leased up, there's not as many things to do with it. There's no vacancies to lease up. But as per the lease agreements, so quite a few of them are CPI, and there's a couple that are 3% increases. So over the first 12 months, we're going to see around about a $5,000 increase. And obviously that'll just keep happening year after year. As those leases continue to go on. And I suppose the other thing we can look at down the track as well, there might be some potential to sort of strata title each of the tenancies into individual titles.
Yes.
And sell them off individually, to that sub $1 million market where there's plenty of buyers.
Yeah, and actually, that's one of those upsides we always chat about, or I sort of bang on about it, I guess, in the course. When you're buying something that at say 9% net, and then if you do move down the path later in the investment's life and strata it up and sell them at 6% because they're smaller properties, well, obviously there's a fairly substantial increase in value there just because of that play on the return. So and of course the demand for lower priced smaller bits of a property. So let's move to the last slide, Tim. And so the investment summary now, just all you guys, anyone that's interested, just contact, best to email you, Tim, or call, or
probably best to go to activepropertygroup.com.au.
Yeah. Okay.
So on that website, there's a bit to register. You just put your name and email in. And what we will then do, we send you the information memorandum for the opportunity.
Right. Okay.
So we'll send that through, but people do need to register because it covers off on all the confidentiality before we send through the information memorandum. And then by all means, once you've got it, happy to take phone calls, happy to take emails. All my details are there.
Right.
Please, don't be shy. happy to take calls. We are only raising funds for this for the next couple of weeks until the end of the month, and so we don't feel that it's going to last too long, given the sort of the level of returns that we're showing. It's quite unusual. This is definitely the highest yielding property that we've ever put forward to the market, and it's we've had a phenomenal response to date.
Yes.
So as soon as the property settles from day one, cash flow in your pocket after all fees is 11.2%. Once we have in 12 months' time those rental increases that we mentioned before, the extra $5,000, that means we go up to 11.48. And then obviously it keeps going up and up and up from there as those increases keep coming in. So it's just one of those super high cash flow type of properties. And then of course we've got the potential capital growth as well, which you never know what it'll be, but we're sort of betting that it's going to be significant. Just where this, what Rockhampton's going for it. We can see in a couple of years' time that yields can come down as well.
That's right.
I don't think it's going to stay at a 9.25% yield when interest rates are dropping. So hopefully we'll get a little bit of uplift there as well.
That's right. I think generally, I mean, we've just seen obviously in the last particularly in the last 6 months, there's been tremendous compression in yields, meaning of course. Cap rates are going down. Some deals in Sydney are selling at 2% cap rate. So obviously, if someone bought that property at 6% cap rate, their property's gone up 300%. This is, and actually in the paper I just mentioned it before, Tim, we're just reading actually on commercial realestate.com.au just this morning how the cap rates in the regional areas are sort of compressing downwards. So it's not to say there's deals, all the deals are gone, but you do have to look harder for deals that are going to show, sort of in the 7s and 8s. I mean, we're all hopefully only paying around 4% for our money at the moment. So it's not hard to work out, how much cash flow you can get from these deals. But it is getting harder to find ones with high cap rates like this. So, well, that's great, Tim. I think, anyone that's interested, register at activepropertygroup.com.au. Certainly have a good chat and any questions from Tim once you get the IM. Fire the emails off and the phone calls, and I'll be interested to see, Tim, how it goes in the next few weeks.
Oh, indeed. No, thanks, James. That'd be great. Look forward to hearing from some of your students.
Excellent. Thanks, Tim, for your time.
Thanks, James.